In this video, we're going to talk about Senseonics. If you're considering buying Senseonics shares in your portfolio, then please keep watching this video until the end, because it'll cover many of the factors that should be considered regarding buying, holding, or selling the shares. During the most recent trading session, the stock opened at $3.07 and closed at $3.62. The lowest point at which it fell to has been $3.04, and the highest point it rose to was $3.75. Compared to the current price action, its 52-week low was 35 cents, and the 52-week high was $5.56. The current trading volume of Senseonics is 97.8 million shares compared to the average volume of 24 million shares. The trading volume of Senseonics shows that there is a lot of interest to buy the shares at the moment. The stock has increased by a lot recently, and this is the main reason why the demand is higher. Keep in mind that the current stock volume is almost exactly 4 times higher than the usual volume under normal circumstances. Based on my experience, I would say that this will last for quite a while, and we'll be able to push for even higher levels. Now, let's take a look at the enterprise value of the company, which represents how much the company's assets are worth once the debt is paid off. The enterprise value, or EV, of Senseonics has been on a very bullish run since the beginning of 2020, from just $126 million at Q2 of 2020 to $1.2 billion in the present day, increasing by almost exactly 10 times over a year. I believe that the company's value will keep increasing upward, but we will probably going to see a much more graduate and moderate growth compared to what we're seeing right now. Of course, the stock is currently very volatile and it can increase by another $500 million by the time this current run is done. We have no way of knowing whether that is going to happen, but one thing is for sure, and that is at some point, the growth rate will get back to something closer to normal. Another outside signal to observe is the total number of shares outstanding. Generally speaking, if the number of shares keeps increasing, then it suggests that a company is selling the equity to keep the ship afloat, to pay off its bills. The number of common shares increased over a year as well, from 230.6 million shares to 428 million shares to present day. This increase is much slower than the increase of market cap and of enterprise value, indicating that shareholders have done the right choice by holding the shares during that period of time. Just keep in mind that the company may still have to dilute in the upcoming month, simply because the operations take time to fully take off. Overall, the price trend of Senseonics suggests that the company has now resumed its bullish run upward after a long period of price corrections. I believe that the company will have a great run in the upcoming weeks and then enter in a new wave of corrections. There is one major difference to what happened before, and that is the market sentiment. The sell-off we saw across the board from February onwards is not completely gone, but it is now priced in the expectations of many market participants. I don't think that it's going to dip as hard as it did a few months ago. Overall, my recommendation is to increase the holdings in Senseonics, but to always keep in mind that all price peaks eventually have pullbacks as a response. From the price actions patterns, we may be able to get a glimpse on whether the stock still has enough steam to go upward. I believe it does. Meanwhile, the financial market's overall sentiment is still relatively reluctant at putting more money into innovative and growth stocks at this time. We're now over the stock craze of 2020, and most investors decided to pull back massively from the entire disruptive, innovative growth stock sector, covering biotech, EVs, and anything requiring keynote presentations instead of financial statements. Going forward, the focus of the market will get back to the financial stability, the longevity of the company, and whether the company has solid financial outlooks. In other words, the blue chips mentality has once again taken over the startup mentality, as the go-to investment mantra. In the current circumstances, the recommended approach is to be careful when buying stocks. On one hand, the stock may be able to climb back on its own when operations begin to pick up. On the other, the stock may simply increase because it fell low enough. This means that in the current market settings, we need to tread the water carefully regarding buying stocks. Many of them became overpriced over the past 12 months, and we may need to wait for another few weeks or months before the timing is right to increase our holdings. With that being said, it's clear that many stocks are now recovering from the sell-off earlier this year, and I believe that the current timing is good to target those that have been oversold over the past few months to make rapid gains as long as we're careful when pacing the amount we buy. Of course, there will always be sudden events that will create a lot of volatilities for individual companies, and this is why it's always recommended to hold a small position in those stocks in case you fear about missing out. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.